right, Patrick, I know that everyone wants to hear about the evidence we have of distressed sellers, which we're going to get to in a second. But first, let's talk about a little bit of a market update. And I want to just caution people that when we talk about a market update in this show, Rein It In, we often give charts, we show data, we show national data, we show provincial data. But when you're a real estate investor, especially if you're an advanced real estate investor, a sophisticated real estate investor, you want to get right into the region, right into your neighborhood, right into your city. And the way you're going to do that is by using technology like DI Vault. Now, we don't have time to show that today on this show, but go to di-vault.com, get signed up for one of those information sessions so we can show you how the regions are so different. Because, Patrick, now more than ever, regions are different. You got one that's in a seller's market, one that's in a balanced market, one that's in a buyer's market, and they're all right beside each other. It's amazing what the DI Vault can show you. But let's get into this part of the show in terms of a general market update, because this is interesting.
Yeah, when you look at house price expectations and you start to see that there is an expectation that things will start to flatten out, I don't see, I think then depending on the market that you're in, and then you have to look at property type. This is where these charts are kind of useful. I think we have to always keep in mind that property types fall into this or impact this, as well as the regions that we're looking at. So as much as there's an overall sentiment of what's happening, we have to look regionally, and then we have to look at property types, because right now what's skewing numbers is, of course, what's happening in Toronto and the GTA in terms of condos, because that's really shifting the market.
The part I want everyone to realize is, like, this is a good example where they're talking about, this survey shows that Canadians expect house prices to go up roughly 5% annually in the future, up sharply from the 2% at the beginning of the year. So people's expectations are starting to change. The fact is this, though, folks, if you're a real estate investor and you kind of got into this game, in the last 3 years, you may have this expectation that prices are supposed to go up, 8, 10, 12, 20%, which is absolutely ludicrous. So just everyone understand that as a real estate investor, if the market goes up 2, 3, 4%, that is phenomenal. I mean, that provides you an incredible return on investment. And I one time had a friend of mine sell some property in a really small northern community here in Ontario. And a lot of people thought, oh, you probably didn't make much money. But we actually ran the numbers, and that market over the course of the last 30 years, when he owned that property, and he owned it for 30 years, that market had gone up on average 1.8% per year, which doesn't sound like a lot. But when you combine the ROI of 1.8% house appreciation plus mortgage pay down plus cash flow, when you add that up, you're looking at a 15, 18, 20% return on investment year over year for 30 years. That's phenomenal, Patrick.
How does it feel to live my dream?
Well, you don't, and you got to keep in mind, you didn't mention in that, all of those things that you said were true, but it's on top of leveraging your capital, right? So instead of getting, 2% of 100,000, you're getting 2% of 500,000 if you're putting 20% down. And back to what we talked about earlier, when I started investing back in 2000, 2001, I put 25% down right across the board. Probably 90% of all of the real estate I've ever bought, I've put 90% down or 25% down. And what we're seeing today is certainly, 20% down or even less. And that's part of what the challenge was coming into these tougher economic times, is there's no equity in there. It's over leveraged. But back to what you said is that the expectation of 3%, 2%, 5%, I mean, you're hitting home runs because it's leveraged capital.
100%. That's a really good way to put it, Patrick. Recently, folks, what's happened here, and this has happened quite recently, we've seen, this is an Ontario chart here, but if you look at your local province, you'll find something similar, most likely, which is we've had a lot of new listings come on many markets, and that has pushed many markets from from sellers markets to balanced markets, or even into buyers markets. And again, just a reminder that if you want to see individual markets, we have this, and we can show you this on the DI Vault, di-vault.com. Get signed up for an information session. But a lot of markets, Patrick, have went from a seller's market to balanced or buyer's market. This is happening across the board. And respectively, is some are just balanced or some are balanced, but just at the tip of kind of just about to become a seller's market. There's a big swing between things in terms of whether it's a buyer's market, seller's market, or a balanced market.
Well, and I want to, and I know I might be getting, we got to go back to the fundamental, which is aside from regionality, which we keep beating that drum. I want to go back to property type. When you look at sales to new listing ratios in Toronto or in Ontario, Toronto, GTA, I mean, there's literally thousands of condos that are coming onto the market, and that's really skewing these numbers. So if you were to break that down and look at detached, it would change the scope of what this sales to new listing ratio is.
Yeah, 100%. The other thing, this is a very interesting chart. Now, the headlines have been blown up with this, so I'm sure people know by now. But in terms of, the GTA specifically, the September real estate sales were almost an all-time low in terms of the number of units sold. It was really, really low. In fact, you got to go all the way back to 1998 in order to see it any lower than this. And kind of you can see this, the 90s, where the kind of market was very sideways in the middle of the 90s. That's the kind of behavior we have here. And that's what's happening. This is, again, just a general market update of what's happening in the GTA.
But I want to add to this, JG. So I look at a chart like this and I go, well, what does this really mean? Okay, so I'm a sophisticated investor. I'm looking at this and I'm going, okay, sales are really soft. It's like record lows. What does that mean? And we have to consider what I talk about often, which is what is driving our economy. And what is it? It's housing. It's such a big part of our economic driver in this particular country. So when I start to see sales getting soft, what is the ripple effect of sales coming down? Again, it's not good news. To be honest with you, that affects a lot of jobs. I mean, aside from the realtors that are going, gosh, I got to make a living, you're now looking at all of the kind of things that, think about what a house sale initiates, everything from the lawyers to the administration, that's one part of it, to the banks and the bank employees, that's another part of it. But think about, I got to renovate that. All of a sudden there's a handyman. All of a sudden there's nobody's going to Home Depot as much. So we're starting to see the ripple effect of this slowing down in Canada, specifically when you look at what drives our economy, drives our GDP. This is bad news in terms of what's happening economically.
Yeah, agreed, Patrick. One of the things I've been saying for some time is, and this is definitely not, this is not great news, but I've been saying for some time that the big drop has already happened. And this is a good example, Patrick. If you look at September 2020, you had 11,000 sales. 2021, 9,000 sales. Then they started raising interest rates at the beginning of 2022, that kind of at the end of the first quarter. And by September, we went from 9 to 5. We cut it in half. And then now from 5,000 to 46, 42. So down another kind of 8% if you compare year over year. So, the big drops already happened, Patrick, and it'll be interesting to see where we go from here. But this is, again, back to one of the things we talked about in the earlier segment of the hibernation kind of season we're in right now, where a lot of people are hibernating. It's showing up in these numbers, Patrick.
100%. And it's not like if you take out the highs, JG, on that particular slide, let's say you take out 2021, 2022, you look back on this particular chart, look back into 216, 217, you start to see the drop isn't as dramatic. But if you're comparing this drop from a percentage point of view, or even this chart, if you take these highs out, you go, okay, yeah, it's definitely slowed down. It's a record slowdown. Got it. But in the scope of things, if we keep comparing to the maximum height of things, it really skews our view of the world.
That's a good point, Patrick. I would say I'd have to plot this out, but I think, just kind of rudimentary here, I'd probably say that the average here over the last, call it 20 years, since 2002 to 2022, the average is probably like in the mid sixes. So you're from the mid sixes down to 5,046, 42 this year. It's a very good point, Patrick. You gotta normalize this data, and this is a prime example of what the media does, Patrick. Is they'll pinpoint the highest point and the lowest point just to have a big percentage to have some clickbait out there. And that's unfortunately how people make real estate investing decisions. That's a wrong thing to do. You got to really study these charts.
Well, and let's just take a minute again on this. The pain points are for anybody who bought in 21, 22 without a plan, who actually were buying it because they were going to ride the wave, they were going to get rich, they were speculating, not investing. That gets a lot of noise. It gets a lot of media attention. And that's where mainstream media shines a light. All those people that are going, the builder ripped me off and this happened. And oh my gosh, I can never afford this. And now I can't close. The interest rates, all true, by the way. But let's face it, many of what you're seeing here are driven by speculators who got into the market and then are getting their butts handed to them because they made really dumb decisions. So I understand, but
is now a good time to point out that we told people not to do that, Patrick? Is that a good time to point that out?
Oh. No, something I told you so's are never good.
You're right. But we did point it out. We told people to be cautious the same way I'm telling people now. If you're going to have a long-term view of real estate, now is a fantastic time. We're going to talk about this in the evidence of distressed sellers segment next, but man, there's some incredible deals out there. And if you got your head on straight and you know what you're doing, you can pick up some real bargains right now. I haven't seen this kind of opportunity in a long time. And in a couple of years, you won't even remember this. But anyways, more on that in a little bit. This is a great chart, Patrick, that talks about the construction that's required to fill the supply gap. This is just in BC. Ontario has a very similar chart. In fact, everywhere in Canada has a very similar chart. And I already know what you're going to say, Patrick, which is this ain't going to happen. I know that's where you're going to go with this.
Well, there's nowhere else to go with it. It's not going to happen. I mean, I think CMHC had a goal of building, what the heck was it? I don't know. I don't remember what the number is. Let's say it was 1,000 over 5 years or 7 years or something. They built 12. I don't remember the exact amount, like literally 12. And so when we look at the bureaucracy that it takes to pull this kind of stuff off, the bureaucracy isn't going to, this is just not going to happen. It drives me crazy that they put this out there and people buy into this. It's just not going to happen. And that can sound very critical, and it is. But the reality of it is that they can't pull it off. So what else is there to say about it?
Good news for real estate investors that are already in the market, because this is like a protective moat around your business, which is great.
And it doesn't, and let's face it, it doesn't make it easier for investors. I mean, the opportunities are there, but it's not like you're walking down the street, picking up deals. I mean, that's getting more common, but the government isn't going to fill the gap that we need for housing, and certainly housing, and even affordable rental housing. It's just not happening. We can't. It goes back. It's very, very straightforward. The government that is causing the problem is not going to be the government that fixes the problem. And the fact that we even consider the government being a solution is just asinine. This needs to get back into the hands of entrepreneurs and capitalists who can actually take on a project, follow it through, and get shit done.
Speaking of capitalists, Patrick, what's this chart all about? Because this is an interesting chart that is definitely, if it hasn't been in the news, we're probably putting it on the news. But this is showing that there's a huge percentage of properties that are owned by investors. And these are the kinds of charts that get so much attention. And this leads to politics over policy, by the way, these kinds of charts. So explain this one to us.
Well, I mean, there's not much to explain here. It's really looking at what are investors, because people in general want to blame investors for the rise in housing and the lack of supply. And because there's lack of supply, that means the costs are going up. And if investors weren't buying houses or buying real estate, we would have more supply for those first time or next time home buyers. And while there's some degree of truth to that, there's the other side of that equation. First and foremost, not everybody wants to buy a house now. That's not a thing. There's lots of young Canadians and who don't want to buy a house. They don't want the responsibility. They don't want the debt, and they're happy to rent. The bigger issue is that what they negate is the fact that over 50% of rental accommodations are supplied by mom and pop investors. And so not the boardwalks and not the black rocks and not the big REITs. I mean, there's lots of supply from them, but a majority of the supply is from mom and pop investors. So, they shine a light on this. They make it all wrong. You look at where it really is in the condo market. That's primarily what's driving it. A little bit more in the row housing. And you start to see that when it comes to single detached or semi-detached, it's not as big a factor.
Yeah, good point, Patrick. And like I said, these are the types of charts that the media will have a field day with. So that's why we talk about it. We go through it. We debunk the myths if there are myths to debunk. But that's a bit of a market update, ladies and gentlemen. And again, if you want the specifics of your particular market, please go to di-vault.com. We have some incredible info sessions we're doing. We're showing people some incredible technology. It could really, really help you identify incredible opportunities. In fact, I do a demonstration in that event where I show people how we go from 36,000 properties that are available down to 4 or 3 or 2, where you really see where the deals are, and you're able to do that in 5 minutes or less. Incredible game changer. So check that out, folks.
If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
If you want to see more stuff like this, click here. If you want to see the entire show, click there.